Welcome to the Financial Freedom Series. My name is Andrew Bean, and I'm here with top mortgage broker and financial expert, Via Lagos, founder of Lagos Financial. How are you, mate?
I'm good, Andrew. How are you, mate?
I'm fantastic, buddy. Super pumped to have you here with this new series, mate. How are you feeling?
I'm excited. Yeah, it's something that's been on my mind for a long time to help people with their finances, prepare them for a mortgage, prepare them to buy property.
All right, mate. So today we're actually kicking off a six-part series, a six-part financial freedom series that we have put together to help and educate investors on how to improve their borrowing capacity and making themselves look overall better to the bank, mate. And I know that you're the man to talk to for that.
Yeah, well, I've been in the game for close to 17 years now. So, broker for 8 years. So, yeah, happy to be on, happy to help as much as I can.
That's it, mate. And I guess like the way you need to look at it is also like the more debt you can take on, the more debt that actually cash flows, not debt that it puts you in a negative position, but puts you in a positive position, the more money and more wealth you can actually make. So that's really the important piece on this. We want to be able to help investors and, every single person to get into some kind of property, hopefully a commercial property that's cash flowing, to basically find financial freedom. Because at the end of the day, that's why we're doing this. We're trying to get to financial freedom so we can choose what to do with our time instead of having to go to the 9 to 5.
No, exactly. That's why I started my own podcast because at the end of the day, people are going to get into debt. And if we don't have the right help to use debt to, propel them forward to financial freedom, it can actually put them backwards. So,
yeah, that's it, mate. All right. So in today's episode, we're going to be talking about how to clean up your act, how to make yourself look better in the bank's eyes in terms of not spending so much money on, incidental crap and making yourself really being able to have really good borrowing capacity. Because like we just said, the more debt you can take on that cash flows, the better position you're going to be to actually buy more property that cash flows and to reach that financial goal. So, mate, how many months prior to like applying for finance would you start trying to clean up your act in terms of looking better for lending for the bank?
well, it depends on your goals. So if you're going to want to buy a property and you don't have a deposit, well, the sooner the better. And it might take you 12 months to get there. So if you can start managing your money now to prepare you to apply for finance between, say, 3 months before you actually apply, at that point, your money should be working and you should be looking good, ready for a bank loan.
So you think 3 months is enough, or would you start possibly doing this like when you start saving for that deposit? Like that could be like, 6, 12 months, 18 months, even 36 months out sometimes for these big monster deposits you need for commercial property.
Yeah, look, I mean, if you just think about how much of a deposit you need and where you're starting from, you might need 12 to 18 months to get there. It depends on where you're starting from. If you're really bad with money and you got a lot of debt, yeah, you want to start well in advance. I'd say 12 months, 18 months at least.
So when do you apply for finance? Like, will the bank go through your actual bank statement? Well, sorry, when you actually go through to apply for finance, will the bank just go through the statement that you give them, or do they have access to be able to look beyond like the digital records or basically whatever they want to look at?
Yeah, so at the moment, there's a thing that's coming out called open banking. It's not out yet, but while it's not, the bank will only have access to see the statements that you provide them. And for an application, they usually just want to see the account where your salary gets paid to or your main transacting account. But say you get paid and you just transfer that money out the same day or the next day into another account, they're going to want to see that account too. But if it's just your main account, your bills get paid from there, but then you save in separate accounts, they're not going to ask about the other ones. They'll just look at that main one.
And so this thing that's coming out, does that give them access to basically look through all of your bank records willy-nilly? Just
Yeah.
like they'll be able to know that at 11:50 on a Saturday night I ordered a McFlurry from Macca's on Uber Eats.
Yeah. Yeah, look, no one knows exactly what it's going to look like because Open banking will allow you, say you're the borrower, to give permission for other banks to see all of your transactions. And then, but more importantly, it's going to have a holistic view of money in, money out, and how much is your surplus, and then what's your affordability on that surplus. So it's got a potential to help a lot of people because it's like true real life real time data, and then that will then allow you to work out. Well, I think it's going to go to a point where you're going to get interest rates and risk ratings based on that, right? Because it'll take a holistic picture, but we're not there yet. So right now, the way to navigate it, to be ahead of the curve, is to manage your money well, and that's why we started this podcast.
Yeah, that's awesome, man. I did notice, like, it's probably happened for like, probably the last 3 or 4 years or something. When you're looking at your statement in your bank records, there's all different icons and stuff and little pictures to make it a lot more easier to understand. Is that for the bank to understand, or is that for us to understand?
Yeah, it's definitely being sold to us, like it's for us to categorize our expenses, right? Yeah, but the thing about managing money is that you're not going to figure out only looking backwards, right? There's a lot of apps that track your expenses. You can auto categorize it. You can have these little icons that show you what you spend it on. But not until you have an understanding of how much money do you actually need between now and next payday can you actually get ahead. And that's where people get unstuck. Those apps don't show you that. Some of them do have predictive billing, but I personally use another app. It's called Timely Bills. There's a few out there.
Oh, cool.
Yeah, there's been like Pocketbook and Money Brilliant. A lot of them get bought out by banks, but the one I've been using is Timely Bills. So that way you can actually see how much money, say you get paid today, and then between now and next payday, you've got rent, you've got electricity, you've got phone bill, all this stuff that has to come out. If you don't track that, you just see the paycheck. So say you get paid $2,000, you're like, awesome, I got $2,000 available. So then you go spend $1,000. And then all these bills start coming out. It's like, whoops, I actually didn't have $1,000 to spend. I only had like $300, right? So that's what the apps, the banking platforms are lacking. So that's why we have to be proactive to see. So once you know exactly what's going to come out between now and then, and you put money aside for your day-to-day spending in a separate account, ideally, then you can start investing the difference, or you can hammer down debt. That's how I did it.
So is the timer build, is that paid app or is that free?
No, it's free. It's free. So you have to manually put in. Yeah, it's really good. So you actually just put in the amount. It even has icons as well, by the way. Like, so you can select the provider and say when it's due. And I've started putting everything in there, even like property expenses. So then I now know that if when a bill's due, how much it's going to be. And the good thing is in the app, you can actually tick it off when it's paid. So you just go tick, paid. And instead of getting a negative feeling, because this is what happens with people, they get a bill and they're like, oh, I'm going to pay a bill. But why are they feeling negative? They got a service for that, right? They just had internet for a month, or they just had electricity for a month or 3 months. So why should they feel negative? It's because it's sent to them by email and they didn't know it was coming. But if you know that is due and you have to pay it, and you have a little tick box, it's like a little dopamine hit. So you end up getting a positive feeling to pay a bill. So that's where it really helps to recondition yourself.
Yeah, I remember when my fiance and I, a long time ago, we were saving for our principal place of residence. We live in Sydney, so we needed to save a fair chunk. And we got excited when, we'd be able to like pay all our expenses. And then you saw like, okay, I can put away like 3 or 4K this month. Sweet. Like, we're going, and you start seeing it like build up and build up and build up. So it is quite exciting. But I think it's also one of those things that maybe with this app, like you have to keep your finger on the pulse. If you look at it every day, like something that you pay attention to every single day is front of mind, and you're more likely to actually keep on going and keep on saving. It's like when you say you start at the gym, right? Say you start at a CrossFit gym. The first month is going to suck like so bad. Then after you've done it for like 2 months, you'll probably start seeing noticeable change in your body. And then you'll start like seeing abs, or you'll start seeing a few muscles come up. And that's when you get more spurred on to do it. So I think the app, I'm definitely going to download that after this session, because keeping your finger on the pulse, because I'm not sure how long or how many times a day or how frequent people check their bank balances. but like I do it pretty much every day because I'm always like want to see progress. You
Yep.
know, so this app might be a game changer for that.
Yeah, look, it's helped me, and I've been doing it. I used a different app before, but I've been doing it for at least 2.5 years, maybe even 3 years now, and that was a game changer for me because I always knew that I was gonna have enough money for my bills when they're due, and then I knew what was left, and I would transfer that money into other accounts. So then, obviously the word budget, people don't like that word budget, but if you
Yeah.
know what your cost is to live, like your groceries and, having an account, like you said, you're married. My wife and I had personal accounts that we would have our personal spending because you still got to have some freedom to spend money the way you want, but up to a certain limit, right? If you got access to the main account, you can easily overspend. So then it's like a weekly allowance. So then if I want to buy her flowers, she doesn't know I bought them, right? Because she doesn't
Yeah.
have access to the account. If she wants to, buy something for me for my birthday, I won't know what she bought. So it's important to have that freedom as well, up to a certain limit. And then you can adjust it as you go. That's the thing. People think that, once I've set a budget, it's stuck now. I can't live freely. The key is to be able to, spend the way you want to spend and not feel poor, but still save up money. And then, add another layer to that. You have to automate it. All right. And we'll talk more about automation later.
Yeah, well, I totally agree with that. Like having a separate account or a bucket for spending. And I remember like a little while ago, actually, it was quite a while ago when we were in our saving mode. They say like you put X amount away in that account, and no matter what, you have to spend it. Even if you just spend it on the like thing, you just have to spend it. It has to go to zero every single month, so it feels like you're not like you're not
Poor.
holding back. You're not feeling like you're missing out. So you can still go out there and you can go have a really nice night, or you can go spend $100 on a big night out with your mates and stuff like that, and not feel bad about it.
Yeah, yeah. But I think the key is that you can do what you want with it. It's guilt-free spending. So some people want to put some money on crypto. That's just what they enjoy doing. But that you don't want to have access to all your savings to do that. But if you've got a personal account that you're putting away, $50 or $100 a week or whatever, and you build that up, and you can go invest in different little things, you can if you want. Or if you want to pay back, your joint debt, or if you want to add it to your combined savings, you can. But at least it's your choice, and you got to have that guilt-free spending as well.
Yeah, I did notice that Bitcoin has actually gone up. Not that I have any invested in Bitcoin, but I do have a bit of a paper trading for fun. And I bought us some Bitcoin at like, I think it was like 17,000 US, and that's, up a little bit. So
Yeah.
not a good investment in my mind, but still
No,
just for
look,
fun.
I used to put money into crypto, and I don't anymore. And you talked about earlier about using your net banking account every day, checking it. Well, when you've got a crypto or multiple crypto wallets, and you're seeing the news and you're seeing all these updates on YouTube because you're following those people, they're always talking about the price. So what it does is it takes you on an emotional roller coaster. So that's when
Yep.
I realized I don't want to invest in it anymore because it's going up and down, and it's taking all of my attention and my emotions with it. So, and it's not stable, and it's not income producing. Of course, there's things
Yep,
like
that's right.
DeFi and whatnot, but I think if to keep it simple, when you invest in property, you're leveraging, you're borrowing, you're contributing your savings, but it's an income producing asset, and you're getting capital growth if you invest well as well. So it just makes more sense.
Yeah, well, that's the big issue with like stocks and shares and crypto and stuff like that. Is it's so liquid that you can make a decision on an emotion straight away. Whereas with property, if you decide to sell a property, that's a good 30, 60 days potentially, and you're committed. There's many different choices you have to make along the way to actually sell a property. Like I want to sell it. Okay, I've got to find an agent. I've got to find a seller. I've got to do all this kind of stuff. So there's I've got to have there's lots of little mini choices and selections that you have to make so you can actually sell that property. It's not just a click of a button. But in future, if property does get put onto the blockchain and using what's the thing called God, I'm blanking on the the artwork, digital artwork they're using now.
NFTs. Yeah.
NFTs, yeah,
Yeah.
that's it. So if you use like NFTs for like property, which people are starting to do, where you like sectionalize it, or you basically can buy into a property through using an NFT. It might become more liquid like, and then so with the way that the conveyancing can be done online, even now or like in future through the blockchain potentially, it could unfortunately become more liquid, so it could become a more of emotional asset as well.
Yeah, yeah. I mean, it's already emotional as it is, right? For people that, want to chase that
Residential, yeah,
residential.
yeah,
Yeah, exactly.
buying,
So,
yeah, and
but you're
selling, I
right.
guess.
If they could buy and sell, the same day, oh man, I don't know. It would be hard because there's people living in there, right? There's going to be rules around that. So, oh, by the way, I
Well,
don't own your
not if
property
it's a
anymore. This guy
commercial
does. Like
property.
what? Yeah, there's a
Yeah,
lot of
that's it, man.
contracts
So I
involved.
think, yeah, so I think that app might be a game changer. So what do you think about putting together some kind of how to use app, something like that, or how to use like Timely Build, and then we can set that up as a free giveaway for the listeners? What do you reckon?
Yeah, yeah. Happy to do that. Actually, I can do some screenshots and show you
Yeah,
how to
how
set
to
it up.
utilize the tool
Yeah,
better. Yeah,
yeah. It's not too
I reckon that
difficult.
could be
Yeah,
a goer.
yeah. Give it a go. But yeah, for sure, we can do that for the listeners because yeah, it has really changed the way I look at money. It's given me a positive feeling when I pay bills. I always have enough, and even if you don't, like say you know you had to, you got investment property and there's not enough money that month because you had to fix the water heater, like you mentioned, right? But of course,
Yeah,
now you know that you need to move money into that account, right? Because
yeah,
you've got something due. But if you didn't monitor it and you're relying just on the cash flow on the property to pay all the costs, you could easily fall in arrears. And if you're preparing yourself for future finance, one of the things you never want to have on any of your accounts is arrears or late payments
mm,
or late payment fees.
yep,
Those are the things that banks, as soon as they see that, they don't want to touch you. I mean, yes, they want an
yeah. So
explanation. Sometimes things do happen, like admin issues. But if you don't move regularly, you don't put your money in the right account, and you're late on things, especially financial commitments like loans and credit cards and whatnot, forget about it. You shouldn't be applying for a loan. You're not ready.
So, I mean, so you're saying that any kind of late fee. So, I actually have had a few times where like we have like different accounts, especially in offset accounts and stuff, where we'll have like your Medibank or like something like that, your private health cover coming out of, and for some reason, it's like a couple of dollars short, and it goes to a late payment or something like that.
Yeah.
I know that's bad. What ramifications, like realistically, does that have?
It depends on what you're applying for and the bank that's looking at it. So some banks actually don't want to see your bank statement. So, about 2 or 3 years ago, that's all they wanted to see. There was this thing about expenses, and I don't know if you followed this. There was a court case with Westpac and ASIC. I think it was APRA maybe, and it was about they called like the Shiraz thing, basically saying that people can adjust their living expenses when they commit to a property, right, or a mortgage. So then they started to hone back on that because it adds more workload to the bank to constantly check bank statements and go through line by line. So if you go to a bank that doesn't ask for them, then and your expenses are what you're declaring are reasonable for your household, then yeah, a late fee they won't even know it exists. But if you're going to the same bank that late fee was charged from, of course they're going to see it. They're gonna ask about it. And if it's a logical reason, like I had money on the other account, just forgot to transfer it as a one-off, it's fine. We just got to cover it off in commentary. But if it's every month and you're
Yeah.
always late and you're constantly putting money from another account or you're borrowing from somewhere else, then yeah, it's a red flag. It means like if you can't even stay on top of your private health insurance, how are you going to stay on top of a mortgage payment?
Yeah, it's just because it doesn't happen often, but it's happened probably like 3 times in the last 10 years. So like it
Yeah,
has happened,
yeah,
and it's just purely because like for some reason because you split up the money in different buckets, like you were saying,
yeah,
and for some reason that's been overdrawn like on one occasion, I'm like, oh my God, like this better not screw my whole credit rating. I'm not going to lose my whole career on one transfer for private health insurance.
Yeah. Nah, look, to be honest, it's not going to, and I think timely bills will help you a lot with that, because that only happens because you forgot that was due and you didn't have enough money, even if it's, $2 difference. That's what happens when you allocate money into different buckets, into other bank accounts. You need to make sure that main account where all your bills get taken out from always has enough to cover what's due. So sometimes you get excited, I want to put $4,000 in savings, like awesome. It's so exciting. I got $4,000 in this account, but then 500 of that you probably should have left because you got rego due.
Yeah,
So,
fair enough.
Yeah, awesome.
So, mate, like in terms of charges on your account, what are the worst types of charges you can start putting on your account? Apart from late fees, has already touched on that, but like things like, what does the bank absolutely not want to see you spending your money on?
Okay, I'll tell you a few. One is gambling. So if they can see you're going to the casino, TAB, online gambling, even crypto. Some of them do see crypto as gambling. That's a red flag for sure. Another one, which is like basically an instant decline, would be payday loans, cash converters, and these pawn shops and stuff that they give you. Give you finance. Yeah, that's anyone who needs that type of finance means that they can't live within their means. So they're behind. They're always chasing their tail. So their paycheck, they're not even living paycheck to paycheck, because that paycheck doesn't get them to the next one. They need to get a loan to cover them to the next paycheck. So yeah, that's a no-go. And believe it or not, excess alcohol. So if someone's spending too much on alcohol, that's also a red flag. You can drink as much as you want, but I had a customer that was legitimately buying wines through COVID. He was collecting them. So that flagged, and I made some commentary about it, and they were fine. But if someone's going to the pub all the time, well, it's a pattern, and they know that if you're going to keep spending that much, you can't say you're going to drop that, because you're probably an alcoholic potentially.
Yeah. So what I'm hearing is buy your alcohol from Aldi to mask what you're actually buying. That's what I'm hearing.
That's not what I said, but yeah, actually probably a good strategy. You're right. It's not a separate store like Liquorland or whatnot. It's in the same complex.
Yeah, fair enough. So, mate, what are the good transactions? What do they actually want to see you doing? Like, how do we boost the the red box or the ticks in our box?
Okay, so what they're really just looking for more than anything is that your pay is consistent. So they want to see your pay matches the amount on your pay slip, and the date that you get paid is the same date you got paid on the pay slip, and the amount doesn't drop, right? Because someone might be permanent, but then all of a sudden in the last 3 months their pay's gone down and it's gone up. Well, that's a sign that you might be casual, or that you've got, there's no consistency in your pay. So that's the number one thing they're looking for, to verify that you actually get paid the amount that you've declared on your payslip. Second thing is they want to see that the expenses that you've declared for your outgoing costs, your day-to-day living expenses, especially the fixed costs, like we talked about bills. People guess a lot of stuff, but if you're way off, they're going to compare that. So if you say you spend, $100 on, private health insurance, but you're actually spending $400, and they see that in your transactions, they're going to ask the question. If you say I only spend $300 on childcare, and they see $1,500 that month, well, they're going to question that. So they're just looking for consistency from what you declare and what documents you provide. All the stuff about going to the grocery store or going out to dinner, they don't really care about that, because let's face it, like you could have a big event, it's a birthday, it's an anniversary, and you can spend a lot that month, but that doesn't mean you can do it every month. So they're logical, right? They're not going to say, oh, look, they spent $500 on dinner, let's account for that every month. Well, that's just that month. So it's more the fixed cost. And then they're also looking for debts that you may not have disclosed in your financial statement, your financial position. So if you say you don't have credit cards, and all of a sudden there's a credit card payment, well, what's that? Or you didn't say you've got, buy now, pay later, Afterpay or Zip Pay. So things like that. But as long as your pay is coming in, and as long as you're also not going in the negative, so overdrawing the account, So there's always some money left. Then you're good. But yeah.
Yeah, cool. So with that Timely app, can you actually share that with your partner as well? Because it's obviously a big thing, and it's not just one person, like, working the finances. It's usually a team of people, like, a husband and wife.
Well, I'm sure there is a paid version, and I'm sure you can do a lot more with it. I just use it
Oh, okay.
myself just to manage what the bills are. So it doesn't manage my expenses. So that is something that I need to figure out. And I can tell you the strategy that my wife and I did for that, because everyone's got their own way of managing their discretionary spend. And you can
Yep.
share your story, how you guys figured it out. But my wife and I actually went to a park and we printed out 3 months of bank statements, and we brought a highlighter, and we brought a pen, and we started to understand how much have we spent in the last 3 months on going out, whether it's birthday party or dinner or whatever. And then we just, like, that was kind of a wake up call, right? Just to see, wow, we've actually spent that much in the last 3 months, and average it out per month. And then we decided how much do we want to spend, and then that was the amount that we sort of committed to spend for going out together. So we had a joint account for going out, and then we worked out our individual amount and how much we want to have every single week for ourselves. And to be honest with you, it wasn't much. It was like $50 a week. It wasn't much. We had to adjust it sometimes, borrow money from a different account. But then we set up separate bank accounts. So then on payday, money will go to the joint going out account. Money will go to the grocery account. Money will go to our individual spending account. And more importantly, and this is what you talked about earlier, we'd have a savings account. And when we stuck to this set budget, and we obviously our main account, which is what we talked about, the bills coming out of that, there's always enough money to cover the bills, but everything else got dispersed into other accounts. So then we'd watch our savings go up and up. So then what happened was, my wife would get a pay rise, and I'd get a pay rise, but all that would change in our budget is us saving more now, because all the expending is the same. And there's something I read a while ago saying that wealthy people earn more but spend the same, whereas everyone else earns more and spends more, right? And that's the trap that people fall under. They're making more money, but they start living a lavish lifestyle. But if you're saving more as you earn more, then you can buy property, or you can invest in other things.
Yeah, it's like keeping up with the Joneses. Like, you have lifestyle creep. That's what they call it. You see everyone in a nice car, in not potentially in a nice house, but like renting a nice house, and you think, oh, I need that nice car too. I am literally about to upgrade my car because we have children, and more room is required after 5 years of having kids. So definitely looking into a new car. But it's just like that. It's like lifestyle creep.
Yeah.
And you really got to watch out for that. And it's actually Robert Kiyosaki actually talks about this, where you pay yourself first. So like if you're working like 38 hours a week, you don't want to just be working to pay other people. You actually want to pay yourself. And he would famously pay himself first, and then not have enough money for his bills, and then he'd put himself in a position where he had to work out how to figure out like to make more money. So, unless he made more money, he wasn't going to be able to pay this bill. But the most important thing was paying himself first into that savings account.
No, I've read that book, Rich Dad, Poor Dad. And, for me, the thing that stuck out was building your assets and reducing your liabilities, and building the income producing assets. So not things like cars or your home, which are, the car is a depreciating asset, of course. It's not income generating, and your home, it's not tax deductible. It's not income generating. So
liability, because you're paying for it, unless
Correct.
someone else is paying for it and paying for itself. Yeah,
correct. It's a cost.
I agree.
Right? It gives you shelter, so that's the benefit, but it's costing you money every single month. And if the rates go up, that's another cost. But one thing I wanted to touch on, which also helped me, because it's a psychology thing as well, right? And what people don't realize is they end up spending more than what they earn when they've got access to credit, like credit cards, buy now, pay later, or even payday loans if they've gone down that path. So they end up spending more than they earn. So that doing this money management that we talked about is so that you can spend less than you earn and invest the difference or save the difference. But the way that I understood it, that helped me, was every time you spend on credit, you're actually stealing from your future self. So say you want to buy a new car, right? And you take out a car loan, 30 grand, 40 grand, whatever. That feeling of driving a new car feels great, but it doesn't last. It might last like, I don't know, a few weeks. As soon as the car gets dirty, or the kids vomit on the seat, or you put a dog in the back, whatever it is, it doesn't give you that same feeling anymore. But so your past self got to enjoy the feeling of that brand new car, but your future self is the one paying for it, right? Your future self is the one like, oh, now I got to pay for this, but you're the one that got to enjoy it, not me. Now it's just a car. I'm just getting from A to B, right? But a car's okay because obviously it's something that you need for the family and whatnot. But I'm just talking about in general, like if you bought yourself a, I don't know, what do people buy?
A
these
Rolex
days?
or something
Yeah,
crazy
Rolex,
like that, just a flash, you just
something flash, yeah.
you're getting the bling to build up your Instagram account.
Exactly. And it's an instant gratification, right? They feel good then in the moment.
Yep.
But even the Rolex won't feel that good after a while because you might scratch it and you don't want to wear it anymore, right? Because you don't want to damage it. But if you flip it on its head and say, you know what, I do want a Rolex. It's important to me, but I'm not going to borrow the money to get it. I'm going to save for it. So you manage your money the same way we talked about. And then you start putting away money every week. And you can set up a bank account. Like the good thing about Australia is bank accounts are free. You can have multiple accounts that don't charge you. Overseas, in Europe, they charge you monthly fees for every bank account you've got. Whereas here, you can have like 7, 8 sub-accounts with no fees. And you can have one, and you can literally call it a Rolex account if you wanted to. Relabel it. And you can put away even $100 a week or whatever it is that you can afford to put aside every week. So you get a positive feeling because you see it grow, right? And then eventually you have that, whatever it costs, say it's 10 grand to buy the watch. You eventually get the 10 grand and you go buy it outright. So now you have a positive feeling throughout the whole process because you were saving. You get the positive feeling because you just bought it and you saved it to get it there. And you get to carry that feeling because you now know that you worked and you put money aside to get that watch. And you get to wear it the rest of your life with no debt tied to it. So you're giving to your future self by saving.
Yeah, that's awesome. What do you think about saving? So you're saving for an asset, right? Or you're saving for something like a watch or a car or something like that. But you keep on saving and saving and saving, but you buy a cash flowing asset that then you can take out a loan and then that buys the car and for the car. So you have the asset and then you also have the car and then the asset pays for itself over time. So you have both of those things, and one of them is obviously producing cash flow, producing potential capital growth in the future. Obviously, the car is not going to do anything for you except for make you feel good and get you from A to B. Yep. It's going to depreciate over time. But that's a very common way to do it too. What do you think of that way?
So you're saying that you get the property first and it goes up in value, and then you buy a car with the equity?
No. So I'm only talking about like cash flowing state, like commercial property. So you're saving and saving, and instead of dumping the money, $30,000, say you could buy have a deposit for a commercial property for $30,000, or say it's a really expensive car, so it's like a $300,000 car, like a Lambo or something like that. So you're saving up that money, but instead of buying a Lambo first, you buy a warehouse. And that warehouse is paying you $60,000 a year. And then you can take out a car loan because the car loan is only $40,000 a year. So you're net $20,000.
Okay.
And it's actually the property's paying itself off, and it's paying for you to have that car as well. So you get best of both worlds.
Yeah. No, I get you. No, I think that's an awesome strategy because while it's paying for itself as well, you're getting the growth, right? Of course, it's speculation. I understand that you can't guarantee growth when you're investing in property. But say you did invest in a good area, and if you just look at stats and whatnot in that area, and it's grown over time, the longer you hold a property. So you're using the bank's money to get you that asset. So whether it's 600 grand or whatnot. So that's just there going up in value. The tenant's paying you the rent, that's covering the cost, which is just the mortgage, because because they're paying the rent and they're also paying the outgoings directly. And if there's still enough money that you can now fund a car as well, right? So it's paying the car loan repayment. Now all of a sudden you've made your initial contribution or your initial savings work so much harder for you. That's what you call leverage.
Yeah.
So you've leveraged other people's money to help you build your wealth and give you the lifestyle at the same time. So I think that's, if anyone can figure out how to do that, or they've got enough money aside to buy an asset that's going to generate that much, hats off to them.
Yeah, that's it. The only way that you can guarantee capital growth is by forced appreciation on commercial property, where you're increasing the income. So that's really the only way, and that's the only way. I never think of like the market going to make me, or like speculating on the markets or capital growth. It's how can I force income onto this property to guarantee the value going up. So that's kind of how I think about it.
Yeah, and that's something that you help a lot of your clients with. Is to look for value add strategies. And I think that's important before you buy a property or commit to something, is to know what are the value add strategies that you can implement as soon as you own that. So you can already predict and, project your money based on that future income. And then, of course, like I said, that property is going to be higher value for that reason. So, it's not based on the market itself. It's just based on the rent.
No speculation there.
Yeah.
So, mate, in terms of like, say you do want to like buy, some fast food, or you want to go out and, buy a new outfit or something like that, would you recommend potentially drawing that money out from the bank, like actually drawing money out? And so you would pay that by with cash. So there's no like digital record of what you've bought for the bank to like scrutinize.
Yeah, I'd say it probably doesn't make a difference, because if you take the money as cash, and then go spend it on clothes, the bank would just see it as an expense, right? And if you just spent it on clothes, they're just going to see it as an expense. So it's not like it actually lets them see it differently. If anything, if they see too many cash withdrawals, that might raise a flag, because they don't know what to spend, especially if it's large amounts. If it's a couple $100 here and there, it's fine. But if you're taking out, $2,000 every single paycheck, and there's no record of how you spend your money, it's going to raise a flag if the bank sees that, because they're not going to understand how do you spend your money. Another thing I didn't touch on is that there's a requirement for brokers and for banks to report, it's under the AML Act, AML-CTF, so anti-money laundering and counter-terrorism. That's something that they always look, and they've got algorithms and things that actually check accounts. So if it's money coming in and money going out and being moved to multiple accounts, that's a red flag, even for me as a broker, if I see something like that. So
while we're on the topic of like creating like a bit of a history of like actually using credit, is it ever a good idea to take out a credit card just to get the credit history up, even though you're not going to use it much? Like if you never had a credit card, you never borrowed any money, the bank, like, how do they look at you differently? Like, how does that change like what they want to do? Because like in their eyes, you're kind of, what have you been doing? Just, sitting in a corner, just eating, Fruit Loops or something.
It's funny you say that. Not the Fruit Loops bit. That is funny. But the funny thing is about the credit file. Because
I probably should have said 2-minute noodles. That would have been the more realistic. Fruit Loops, I don't know why it's that. But anyway.
That's your favorite breakfast, isn't it?
Oh, I used to have Nutri-Grain when I was a kid. That was the bomb, but not anymore. I actually did have it, I tell you, for the first time in like 15 years. Like,
it's just like pure sugar, right?
At my sister's house, when we had a big day and swimming in the pool, that was the only thing to eat. Yeah. And I did go back to it, and it was
lethargic. Not lethargic, nostalgic, and probably made you lethargic afterwards.
Yeah,
sugar crash.
That's it.
Back to your question. What was the question again? Can you repeat it?
Yeah. So in terms of like, should you ever take out a credit card just to get credit history to better your position to lending?
So there are some people who have never taken out any debt at all, and they get to their late 20s, and then they realize, you know what, I've saved up some money. Now I want to actually buy a house or a property for investment. If they've never had a credit file, then it can flag to the bank and they'll ask the question like, how is this person 28 years old and they don't have a credit file? It doesn't mean they won't approve it. It just means that we got to explain it because you got no credit score. And Australia has moved on to comprehensive credit reporting, or positive credit reporting, they call it in America. And that's where they give you a score based on you staying on time for all your debts. So they keep a record of that. You can actually see your if you're late on any repayments. Whereas before, you only used to keep a record if you were defaulted, for example. So having a credit file does help because you have a credit score. And if you've got a credit score of over 800, you're pretty much in the top tier of a borrower. If you're below 600, there's some negative stuff on there. If you never had a file, then I don't even know what your score will be to start with. So what I would say is it doesn't have to be a credit card. It can be like Zip Money or something like that with $1,000 limit. It can even be a phone bill, like a mobile contract that creates or a utility bill if you move out of home. Something just to create your file. And as long as you've got a file, then that's okay. You don't have to take out debt in order for you to get that score. So that's something to keep in mind. But if someone does want to have a credit card, I recommend getting good with money first. So what I mean by that is we talked about managing money. If you're borrowing money from anywhere because you can't afford to cover your expenses between this paycheck and the next one, a credit card is not going to help you with that. So better not get one. But if you're always ahead and you've got savings put aside, a credit card can make it easier for you just to manage a lot of different direct debits and whatever, and then you can as long as you clear the balance in full every month. And some banks will make you fill out a form to do that. Some will do it through net bank. Some you have to call up because they don't want you to clear it in full. They want you to carry the balance and pay interest on it, right? So that's when I would say it's worth it. And in terms of a limit, me personally, I'll just go to the minimum, which is $6,000, which gives me reward points, right? Whereas some people, can go lower, but if it's not giving you reward points, all it is just temptation to use money you don't have. Because why else would you use it? So I think reward points.
Yeah, fair enough. So what's your credit score out of? Is it out of 1,000 or something?
No, I think it goes all the way up to like 1,200 plus. So anyone who's over 1,000 has got a really good score. But I rarely see that.
So 800 is a good score.
Yeah, 800 and above. And you can go to a website. There's a couple of them. Credit Savvy. Another one is getcreditscore.com.au, and it's free. They will probably send you some marketing emails, but you can keep track of your score. You just it doesn't actually do a credit check, so it's not imprinting on your file like you're applying for finance. It's just a seeker view. It's like just you wanting to see it, and then you can just see what your score is. And that could also help you if you've got something bad. Sometimes people have fallen behind on something like years ago. They moved addresses and they don't even realize they've got a negative mark on there. By looking at your score, if it's under 600, then you need to get a copy of your report ASAP and see what's on there.
Yeah, wow. Yeah, so I guess it's one of those things. I mean, it's unpacking that a little bit further. So it doesn't put any kind of like mark on your record where you can see like someone's checked this. I mean, like, how when if you're applying for loans for like different things from all different people, that actually puts like a flag or some kind of like tick or mark on your account or something.
Yeah, so if you apply for finance, then it's not really a problem. It doesn't affect your score, whether you're approved or declined, right? It's only because they don't update it and say this wasn't approved, right? They just show that you've applied. It only starts to reduce your score if you keep applying elsewhere. And this is really important because some people who come from migrants that come to Australia and in their countries, that's how they get finance. They go around to different banks and they try to negotiate their rates, and then they apply for loans because a bank is not going to give you an interest rate unless you apply. So sometimes people don't realize that by talking to a banker or checking for rates online, that they're actually applying for a loan. And that leaves a mark on their credit file. And if they do that 3-4 times in a week or in a month, their score is going to drop significantly. So it's important to not apply for loans. So working with a mortgage broker like myself, I will actually check, your file, do an assessment on it. And I used to work for a bank, so I used to do credit assessments on behalf of the bank. So I know what they look for. That's why I can answer all of these questions. So I do my assessment first without putting any application forward. So if I need to do a credit check, it doesn't impact the file like the credit file like it's an actual application. It's just to see it. And then I can send a copy to my customers and they can have a look at it as well. It doesn't cost them anything. But I only obviously do it sometimes if it's required, but I don't always do credit checks because sometimes you don't need to do them.
Yeah, awesome. I mean, so because there's all these like little like websites where they say like, oh, 24-hour like finance, like, they'll let you know in, 24 hours or 48 hours. And then some of them do say does not like put a credit mark, like a mark on your credit score. Is that actually true, or is that just like to try and hook you in to actually do it?
Well, I haven't seen specifically what you're talking about with the ads, but if you are getting finance, then it is leaving an imprint on your credit file, 100%.
What if you're just applying? So like you'll go through like a questionnaire that'll like give you a couple of assets and liabilities and what you get paid and what you want to actually, what you're trying to get, how much money you're trying to borrow. And then they come back to you, give you a call and tell you yes or no, or what assets you have and stuff like that.
If you're sharing usually there are a few of them, these personal loan lenders and short-term business lenders, and they might have a tool initially which will do like a quick check, which may not be an application, but the next stage to that is for them to actually give you an offer. They'll actually ask you usually to provide bank statements, but they're not going to ask for bank statements where you download them from your net bank. They're actually going to ask you to plug in your credentials using a tool, which is similar to open banking, but it's using another tool. And that just shares all your data to them from that particular bank account. So that is an application in itself. And that But in the beginning, when you're just getting a quote, it depends on the lender. Some of them will do one application first. Others will just do what's called a seeker. And you got to check the fine print. If it says seeker, so SEEKER, then that's not going to impact your credit file.
And so with credit card, just want to go back to that. In terms of like max limit, what would you suggest would be the max limit you should have, or like the minimum you can actually get?
I think you got to base it on one, what's the minimum limit for that particular card? So, you might want an Amex, but an Amex is 15 grand. But if you're wanting to apply for finance and buy a property, 15 grand will actually hinder you in terms of your borrowing capacity. So you may need to rethink that and get, another credit card from another provider that gives you like a lower limit, like 5,000 or 6,000. But I think a good rule of thumb would be only have a limit that you can clear with 1 month's pay.
Yeah.
So that way you can never get into trouble. So as soon as you go 15,000 and above or something like that, and you can't clear it, you're going to the temptation's there, or something can happen where you can access more money that you can afford to cover and clear, and you're going to be paying interest, and then you're, in a hole basically trying to get out.
So in terms of like, so say like back a long time ago when I first got into the, property and investing and things like that, there was a lot of talk about offset accounts. So we have offset accounts, we have split mortgages, and the idea was you have a credit card, you pay your wage or your money into your offset account because you're offsetting your loan, and then you pay everything for the card, and then you clear the credit card every single month. Is that still a good strategy in your mind in 2023? Or does that really need to be updated because the offset account doesn't really do too much?
Yeah. I have heard of that strategy. It's actually been promoted a lot from different property.
It does get promoted a lot, yeah.
It does. I personally don't think it's that effective because it's too easy to spend more than you would normally spend. So because it all comes down to visibility, right? We talked about earlier allocating money for certain buckets. But if you have a credit card that you put everything on, you don't really have visibility of how much you spend for certain things. So, and you sort of focus in on available funds rather than the balance as well. So if you've got a $15,000 card and you've put $2,000 on it, right? You still see 18,000 available on NetBank. So in your mind, you're like, oh, I got 18 grand. I haven't actually spent that much. But if imagine you had a $2,500 limit and you look on it, says, shit, I've only got 500 left. Now all of a sudden you're not thinking the same way about spending because you're like, I'm nearly maxed out here. So that's why I think it doesn't work, because you end up spending more. And I think I did read an article recently. I don't remember where it was, but it was just showing the statistics of how much people actually end up spending more because they have a credit card. If they didn't, they'd actually spend a lot less. So, which makes sense. Even though they think they're managing it well, when you have everything on the card, you can't categorize it the same way. You can't bucket it the same way. So it makes more sense to not have it for that. But an offset account can be powerful. So some people do the card thing for bills, and then it's interest-free money while their money sits in the offset, and then automatically once a month it'll direct debit from that. It's called a sweep. They'll clear the card in full, and that's gone. I'd say that's a good strategy just for maybe your fixed costs. So you know what your bills are, right? Everything that's going to come out, they're fixed. If you have that coming from your credit card, then you know that you're using the bank's money, which is interest-free, while your money sits in the offset, saving you on interest, but you're not overspending because you're just spending what you were going to spend anyway, right? You're not using it to go for the midnight Macca's run. or whatever it is that you might end up buying a Rolex or whatever. You're not going to be tempted because you made a decision. All your other costs, your discretionary spending or your groceries and all that stuff is being paid from an actual bank account, which you set a limit for per week, and only the bills come out of the credit card. Does that make sense?
Yeah, definitely. I mean, because we've been doing this way for quite a while now, probably at least 5, 6, 7 years or something like that. But I've been looking at it. I'm like, I mean, it doesn't seem like it's really making much of a difference. Unless you've got a really large portion of your mortgage up against that loan to offset it, it's really not doing that much. So
it's
I mean,
true.
we've only got a $3,500 limit on our credit card. And we clear it every month, and it's never goes close to even using that. But I'm not seeing the value in it anymore, and it just annoys me having a credit card. So I might be changing that very, very shortly.
I think just doing the other thing with timely bills and having different accounts and bucketing your funds that way. I think that's much simpler and not even needing a credit card. And then I think you just feel freer and you have full visibility of how much you spent that month.
Yeah, that's it. So, mate, obviously it would suggest that you should close credit cards when you're applying for finance. How long or how far out should you start closing credit cards?
Sooner
does that have any impact?
Yeah, it does.
On anything?
Sooner the better. So depending on if you're carrying a balance or not. So some people actually have credit cards that they just have open, but they don't even use them. They're just there. They might use it occasionally. Oh, I'm going to keep that open if I'm traveling overseas or whatever. But that can reduce your borrowing capacity a lot by having a credit card open, even if you never use it. Because the bank will always look at worst case scenario. How much can you spend up to if you wanted to? And that's the limit. So if you don't use the funds, close the card. Just doesn't make sense. And if you can reduce the limit to something the lowest possible, do that if you need to keep it open for whatever reason. So sooner the better. If you're carrying a balance, so this is someone who has at some point needed to use the funds and hasn't been able to clear it with one paycheck, then you need to have a debt, a way to structure your money so you can pay that debt back faster. And one way to do that is a balance transfer. So you say you got one credit card, you're paying say 20% interest on it, and you go to another bank and you apply for another credit card to pay out that card. So it's like a consolidation or a refinance, but they call it a balance transfer. So then a new card provider will pay out the old card, but they don't enforce that you close it. That's the problem. So this is where people fall into a trap, and I've fell for this many years ago. So say you've got a $5,000 card, you apply for another $5,000 card, that one pays that one out. Now you go on a 0% interest for say 12 months or 2 years, whatever the offer is, but you don't close the other card. So now you've got $5,000 available here. So then you go and spend on that card. So now all of a sudden you got 10 grand worth of debt. So that's where it's not a good strategy if you don't close that card. You need to do that immediately. So as soon as you've balance transferred, close that other card. Now you've got 5,000 owing, 0% interest. You start hammering that debt down. Every time you make a payment, it goes all to the principal. There's no interest anymore because you've balance transferred it. But if you kept it at 18% and then you started making the same repayments every week, there'll be interest as well. So it's going to take you longer to pay it off.
Yeah, definitely. The reason that like I like to have the credit card when there's like no balance on it is like the what if I need $3,500 quickly, like a buffer, like an emergency. But like $3,500 is nothing. Like, it's even silly to have that anyway. But the other like time that we've had a reasonably large, like I guess it was a credit card, was we renovated a kitchen, and it was from IKEA, and they were like, okay, well, we can spend, you can take out a $15,000 credit to pay for this IKEA kitchen, and you can pay it off. If you pay it off 3 years, you pay absolutely no interest on it. So I'm like, all right, well, I'm pretty good with money. I'm pretty sure if I just pay it off every month, we'll be able to pay it off within the 3 years. And lo and behold, we stuck to it, and they didn't get $1 off us of interest. And then as soon as we paid it off, like we are shutting this credit card down. We are not having it. And we did it. And like, it was like, I guess if you're diligent and you have the discipline to be able to pay it off all the time.
Yep.
And we were only paying off probably like $300-$400 off a month, and then obviously got less and less or more and more. I can't remember.
Yep.
But you just have to be diligent with the plan, and it worked out great. But I'm sure there are lots of people that had the same like opportunity through IKEA, and I think the company was called Hum, possibly.
Yep.
That had the offer. But I'm sure there are people that have it, and that catches them, because it's human nature that if you can get it now, like get it now, and you feel like you've got that reward, like you said before, like it's costing your future self.
Yeah.
And it's just it's a big trap for people.
Yeah, and it actually is costing your future self. Even if you don't pay any interest on it and you manage it like what you did, if you went and applied for a loan to buy a property in that time, it's affected you, because now they're going to look at that loan as a commitment, and that's going to reduce your borrowing capacity, even if it was interest free. So yeah, for sure it does. I get it, and it does help. But you're right. Many people have tried that, and they get to the end and they haven't actually paid off the full balance, and now they're paying a huge amount of interest on it. This has been going for years with Harvey Norman and all these different providers. Yeah, GE Money used to do it. Now it's Hum. Yeah, it is a big trap. So get away from the instant gratification. Think I don't want to steal from my future self. I want to actually give to my future self, and just wait, put money aside, save for it. The old lay-by is actually a good thing, because you're wanting to buy something and you're putting money away, but you don't get to walk out with it. Right? Buy now, pay later means you walk out with it now, but you got to pay later. So I actually like the old lay-by. It's better.
Yeah, that's it. The old lay-by. I haven't lay-by something for a long time. That's crazy. So, I mean, are there any other ways that, you would suggest that how to like put yourself better in a bank size? Like, what are the other suggestions that we have? Like, consolidating debt, or like what do you have for me?
Consolidating debt definitely helps. So even HEX debt. So a lot of people carrying HEX, and they're like, well, I don't need to pay back my HEX. I only pay back when I earn a certain income. But that actually does impact your borrowing quite a lot. So if you can clear that ASAP, or consolidate it into one. If you've already got a property and you've got equity, which a lot of people do because they bought in the last 2 or 3 years or before that, and they already held that property, they can borrow at, say, 5% interest, or a little bit less than that if it's owner occupied, and they can, clear their credit card, they clear the personal loan, clear the car loan, clear the HEX, and have it all consolidated into one. They can still pay that portion faster. So sometimes, the downfall is you're going to spread it out over 30 years compared to, say, 5 years on a personal loan or a car loan. But if you split the loan, and sometimes people do this who are smart with money. So say you owe, 500 grand on your home loan, and you're consolidating 100,000 worth of personal debt. Well, you're going to clear all those other loans, not pay high interest on them, and you're going to improve your borrowing capacity. But now you've got a mortgage of, 600,000. So what you do is you keep the 500,000 as your regular home loan that you already owed before, and you have a second loan, a loan split for 100 grand. So now you know that 100 grand relates to all your other debts that you consolidated. So when you're making and you're managing your money, you can start to automate and pay back that 100 grand as soon as possible. So still pay the minimum on your 500 grand because you're going to have to pay that anyway, right? But hammer down that 100 grand loan. Don't put it in your offset, pay it straight to the loan. And another thing that helps is to ask your employer to do it. So they've got sophisticated payroll systems that you can actually just say, can you pay this amount to my normal bank account, but pay this amount into this other account? So you can give them the BSB and account number of that consolidated loan, and then they'll pay that amount straight out of your pay, so you never even see it. Out of sight, out of mind, and that debt will just get paid every single payday, right? And you start living off of what's left, and it'll disappear. So that 100 grand, you end up paying 4.5% on 100 grand over 5 years, or however long it takes you, depending how much you can pay to it, compared to having HEX here, car loan there, paying high rates there, and then ultimately you might end up paying, I don't know the exact figures, but the amount of interest you'd pay back would be significantly less, and that saving can now go towards your home loan, because then that 100 grand will be gone, and all of a sudden you've just freed up a whole bunch of cash flow, and now it goes to your home loan. You start building that up. So that's how it's like this compounding effect. The more you start it, you start to get that compounding effect, and then that can help you to build more equity. And then, the loan's coming down, value's going up, you got more equity, and you can use that to buy yourself a commercial property or an income producing asset.
Yeah, that's awesome. And I guess I don't think people know that like a credit card debt or like the interest on that is like 18, 19, 20%. Like it's through the roof interest. Like it's crazy.
Yeah.
And so when you're looking at debt, should you attack the debt that has the highest interest first?
Yeah, for sure. And that's why I mentioned the consolidation or the balance transfer, because if there is a strategy that you can get that highest interest rate to a lower rate sooner than later and then pay it down, then you're going to be paying off the principal faster. But if you can't do that, for whatever reason, you can't get a balance transfer, you can't consolidate to a lower rate, then yes, just redirect all your extra repayments to that highest interest loan first. And that could also be through your employer or a dedicated debt repayment account, right? Because some of them don't accept BSB and an account number. They only do BPay. So then you open up like a debt repayment bank account and you automate. So you set up an automatic transfer for a set amount to go every single week into that account or every single paycheck. And then from there, you set up a BPay or a direct debit and you pay that straight to the credit card with the highest interest rate. And that will disappear. I did that, and then once the debts are gone, you keep up that same level of that same amount that you were automating, but now you redirect it to savings, or you redirect it to something that you're saving for specifically, whether it's a property or having a baby or going overseas. But at least you can expedite that, and then when you realize that all your money is now being put to savings and you don't have any more debt, that's the most liberating feeling. And then the only debt you ever take is leverage debt where it's income producing and tax deductible. Then it's not bad debt, it's good debt.
Yeah, awesome. Do you help your clients like look through debt and like figure out the best ways to consolidate debt?
Yeah, definitely. If there's equity there, I always propose the idea to do that. And if they don't use the credit cards, I always get them to reduce the limits. At the end of the day, most of my customers, they want to build a portfolio, so they need borrowing capacity. And borrowing capacity has been squeezed because of interest rate rises. So whatever they can do to drop that, I'll help them to do that.
Yeah. So if you're up to your eyeballs in debt and you don't know what to do, then Victor should be able to help you out, give you a solid strategy. Have a time frame, and I'm sure he's has the accountability to keep you on the right track. So definitely try that out. Definitely should be good.
Yeah, I just want to say one thing is that as a broker, it's great that banks pay me for the commission for introducing business to them, but in a weird way, I'm incentivized for people to borrow more because I get paid more, right? So some brokers, I don't know them personally, but I know they exist. They will focus on getting people more debt because they get paid more, right? But for me, it doesn't matter how much debt you get. What matters to me is that you've got the right debt and that you're actually paying down the bad debt. So if you've got lower loan amounts, it doesn't matter if my pay is affected by that, because I know that I do right by you. You're going to come back to me. You're going to refer your friends and your family. All right, you're going to be my client for life. We build a long-term relationship because I'm doing right by you. But that's also how I think. So I want to help people get to that financial freedom. And they're not going to get there by accumulating more and more personal debt. It's just not going to happen. They need to get to a point where they spend much less than they earn, and they invest the difference, and they use the power of leverage and use other people's money to help them grow their wealth.
Yeah, 100%. All right, man. Well, I guess that kind of wraps up the first episode of the Financial Freedom series. Mate, where can listeners go to find out more about you and also your awesome services?
So they can follow me on pretty much any social platform. You go to my website, which is lagosfinancial.com.au. And I have my own podcast called Debt to Financial Freedom. And you'll find me on all the podcasting platforms as well as a YouTube channel. So yeah, and of course from there, if you're wanting to have a chat, there's my email, my mobile number will be there, as well as a calendar booking. So if you want to book a chat with me, schedule a call and see what's possible for you. And even if it's not the right time for you to borrow, I'll help you as much as I can to get you on the right track.
Awesome, man. And did you have a free giveaway for the listeners as well? Something like of a guide or something?
Yeah, so I really do believe that commercial property is a way forward because of the predictability of the income. It's going to go up, long-term tenants. And, your listeners will know a lot about commercial property, so I don't need to be preaching to the choir. But a lot of people don't understand the benefits of commercial versus residential. So I've created a guide, which is what I believe are 5 benefits of commercial versus residential. So, yeah, I'm giving that away. Listeners can download that. There'll be a link, I'm guessing, in your description. You can put that in there. They'll be able to just provide their email, and I'll get that sent out to them.
And we're also going to put together a how-to-use guide for the Timely Build app. Best and worst ways to use the app. A lot of the best ways, I'm sure. And Victor's going to. I've literally just spin this on him now. He did not know about this at all.
So give me some homework to do.
There's going to be a second free giveaway, and I'm going to download the app right now, and I'm looking forward to Victor's how to use guide as well. That he'll be, I'm sure, making at some point.
Yeah,
not because he wants to, because basically put him on the spot.
Look, if it helps people, I'll definitely put it. And I know it's helped me, so for sure I'm going to help us make it as easy as possible. Yeah. Thanks, man. Thanks for having me on. Really appreciate it.
All right, this has been financial expert Victor Lagos and Andrew Bean on the Financial Freedom series. Thanks, guys.